Hello everyone, this is Matthew Frailey with BreakpointTrades.com. We've been bringing you advanced technical analysis, market commentary, trade ideas, and mechanical trading algorithms like you see here since 2003 for individual traders and professional institutions whom I consult with quite regularly. Anyway, let's go ahead and get started here. It's been a couple weeks since I did a newsletter video. There's a lot that's been going on with the market. I keep all my subscribers abreast though, so again, if we do have some paying subscribers to our website. So if you want to see real-time updates from me, I suggest you take a membership. It's very reasonable, and you'll get all, you know, very timely updates daily, trade ideas, system trades, stuff like that. Okay. Anyway, we've got a lot to cover. So this is our back end for our newsletter, and let's go ahead and get that started. Hello, everyone. This is Matthew Frailey with BreakpointTrades.com. This is the comprehensive weekend newsletter for Sunday, March 12th, 2023. As you can see, this newsletter is divided into 8 major sections. If you happen to be new to Breakpoint Trades, these weekend newsletters tend to be quite comprehensive, and that's what this one will be. We have a lot of charts to cover. Probably take us anywhere from 40 minutes to an hour to discuss everything. Okay. Again, also guys, quick thing. Remember the comments from our weekend newsletter last Sunday from Steve. Steve favored a lower high bounce that was in the market, that it was going to fail and come back down, and that's exactly what happened last week, especially late in the week. So good job to Steve for our analysis, and that played out. And also, as you know, again, I'm not going to cover all the details of the Silicon Valley Bank issue. Unless you're under a rock, many of you have read numerous articles on that. As you know, the fallout of that from last week gave people cause for concern, kind of like a 2008 financial crisis, with the 16th largest bank shutting down, going bankrupt. Now, I'm expecting this evening here, just before futures open, and again, by the time you watch or listen to my weekend video or newsletter, the news may have already come out. But I'm expecting the U.S. government regulators to announce some sort of, potential shore up of SVB deposits to prevent wider fallouts. And they're expected to announce that before the futures. Of course, so unless you trade futures, if the market responds favorably to that and gets a big gap up, you won't see that until tomorrow morning when the market gaps up. But we're looking for some news tonight. Again, it's important that regulators shore up the deposits, all right? Because if you don't, then that creates a confidence situation where in a potential run on other banks. So they're going to announce that. We'll see what the market's reaction to it is. Like I said, very short term, the markets are very oversold here. Several of the McClellan oscillators, such as the NIMO, NAMO, have closed below their respective Bollinger Bands. Other indicators are quite oversold. I have some divergences on some of the intraday charts. So everything's set to potentially bounce if you get a news-driven event. Again, guys, as you know, longer term, we have never wavered. We identified a bear market potential way back in December of 2021, and then we confirmed one early in 2022. So we were well ahead of the curve, and we've never wavered from that. Even this year, since the October bottom, a lot of people called for the end of the bear market and stuff. Steve and I viewed the rallies as bear market rallies and the longer term downtrend. Okay. Due not just to technicals, but also to the backdrop, future recession coming, the earnings degradation that we're going to be seeing in the S&P, etc. So again, our long-term view is that we're in a bear market that's going to last for quite a while. We have a lot of issues under the surface, and so we'll see what happens. But Anyway, we'll see how futures open tonight, but let's go ahead and just cover things here quickly. Again, the markets had a pretty good sell-off last week with the major indexes losing around 4.6%, while the Russell lost 8%. And every sector we follow was in the red. Next. Item number 2 shows the economic news calendar and what transpired last Friday. And of course, for the week, you could see bloody red on Friday. We were off the lows a little bit, but for the week, the indexes were down around 4.5% to 8% for the Russell. And if you look at the major market sectors we follow 21 of them. They were all down. Metals and mining down 11.1% with this was the biggest loser, followed by oil services, down almost 11%. Oh, actually, banks. I'm sorry. How could I forget that? The bank index was down 15.75% due to the obvious issues there with SIVB. And of course, financials down 8.5%, brokers down 9.3%. Again, huge losses across the board here. Currency-wise, US dollar closed down on Friday and up slightly for the week. By the way, guys, as you know, inflation has been the problem, sticky inflation. We've saw recent economic data on that. But the thing with the SIVB, that's actually a little deflationary. So going to be interesting to see what that causes, how the Fed will react to that overall. But anyway, moving on. Cryptocurrencies, obviously bloody red for the week. They were up a little bit on Friday, though. Held up a little better. Commodities, bloody red as well. Only thing up for the week was sugar, which we rarely look at. Natural gas plummeted again, down almost over 19%. Crude oil down 3.8%. All the ags were down. Precious metals. Gold managed to close slightly up for the week, 0.8%, but silver closed down 3.5%, and GDX, the gold miners, closed down 5%. The problem with that is that's the fear trade, people piling into gold. But if you followed the precious metal markets for years like we have, it's best when the stocks are leading, and the stocks are not. Stocks are lagging here while gold is outperforming. So whenever I see that, unless that changes right away, I think that rally is going to be short-lived on gold, especially if they come to some sort of deal that the market likes. Gold will come right back down because that's why it was bid up. Plus, silver tends to lead gold. You can see how much silver was down last week as well. Now, as far as bonds and rates, TLT up 3.6%. That's had a nice rally off the lows, and the 10-years come down. Next, item number 3 shows the economic news calendar again. Today, this evening, we have expected news on the SIVB from regulators. Otherwise, this week, obviously, we have the CPI core PPI on Tuesday and Wednesday. Next, before we get into the general market, let's go ahead and just look at our systems. So one thing that has done very well this year is our automated trading systems. So this image here shows you some of the reversion to mean systems. These are for SPY. And over a week ago, they were long. They bought that pullback in late February. They all closed out. Some of these were nice trades like that RSI 40, the trend pullback, which you see on the upper right, and very nice trade there. The bear long was essentially a slight loser. The S-trap had a first and second entry. Second entry was a winner, but we entered that with leverage, so that did make money, and the QEBTS was a winner. So the systems got in, they got out. They got out at the right time. Now, surprisingly, we didn't see any new trades on these reversion to mean systems last year. I was surprised that we didn't see at least, the systems try to take some sort of first entry, but we didn't. If we do get another move lower early this week, I suspect we'll finally start seeing an entry or two from these reversion to mean systems. Remember, they tend to buy when it feels the worst. Okay, they buy when it feels like death, when it's the most bearish. Then they sell when it feels the best. Okay, and they're opposite of what your emotions tell you. Next, Image number 5, this shows you all the subsystems for SPY. Let me zoom out a little bit more here. You can see how many of them there are. You can see just the recent ones we've covered. Again, all these systems are looking for long opportunities on SPY. They are reversion to mean, so they're looking for things to get oversold. They look to get in, then they look to get out on a bounce. None of these triggered last week. Again, they all exited the previous week nicely. And same deal is for ES systems. They also did not take a trade last week. And as I've already covered, I'm working on a basket of ETFs that I'm going to run all these systems on. That's going to be a fantastic product, but it's going to be probably another month or two before I finish that. It's a very difficult project, a lot to get done, but once I get it done, it's going to be one fantastic product. No one's going to have anything out there like it. So I'll keep you guys updated on that. Let's go ahead and move on. Again, the first things, like I said, we're going to cover are the systems here. So this image here, image number 6, this is the KISS trend system for the S&P 500. We show this on the website. It's updated every day, and we update it for other indexes as well. But again, these systems here are long only. They're not reversion to mean. They're unlike the SPY and ES systems. They attempt to catch a trend in an uptrend, have a trailing type stop, smart trailing stop to protect you. They try to keep the stop wide enough to avoid a lot of noise and then they get out. But since we're in bear markets, guys, these type of systems on the indexes like the S&P here are going to be in cash most of the time. You can see where this KISS trend system went long for a month or two, then got out. And it got out about 3 weeks ago here at 39.90, and it's been in cash ever since. Okay. In bull markets, these systems will generally stay long most of the time, but we're in bear markets and they're long only. So, they're just kind of they're going to take shorter term swing trades for maybe 1 or 2 months, something like that. But the nice thing about these systems for 401k longer term accounts is they do give you that stop out area so that you can avoid the big drawdown sell-offs that do occur for people that just buy and hold through bear markets. Otherwise, again, you can see on the daily here a couple things. The DeMark 9 perfectly timed that top there in early February. We lost the smart trailing stop. Then we got a DeMark 9 on the lows early March. We got a bounce up lower high, which we favored. Also bounced off the 200-day moving average, and we've come down. You can see we lost the 200-day moving average on Friday or Thursday and moved down on Friday. Also, the moving average ribbons, these are very good guides. You can see how they flipped bearishly stacked there in mid-February, pinched on the underside. When they pinch on the underside from a bearish configuration, you look for shorts, and you had it perfectly there. Next, image number 7. Here's the 4 time frames we like to follow with our custom indicators. First off, the daily at the upper left. Again, we had the moving average ribbon pinching on the underside. We lost that ATR back in February. It was resistance. We're below the support cycles. 195 minute, 130 minute. We stalled at that resistance cycle early last week on 3637, and then we broke through the support cycle. Whenever you break through a support cycle, that's the cyan colored dots. Think of it like breaking support. That's a trending wave. Same deal on the 78-minute chart. You can see we lost that. You could also see on the 130-minute chart how the 60-period stochastic found resistance at the 50% area. Okay, same for the half-day 195-minute chart. That 60-period stochastic is something I have on all my charts just for that. That 50% area is can give you important areas of resistance and support, and that was resistance here last time. Next, just since we're talking about systems, last week I discussed this very objective setup. It's called the MACD KISS Stochastic 5 system. I actually posted a quick video on YouTube on Friday showing a live trade setup. But anyway, very objective system. So here's this image number 8. This is the daily chart of SPY. And here, if you look, in early March here, you had a perfect short. So if you look here, you had a black candle doji. And if you look at the MACD was kissing on the underside. The MACD did not cross the signal line. And the 5-link stochastic was overbought. Whenever you see that, you have a potential short. You get your trigger off the candle. So your short trigger objectively would have been 1 penny below that black candle doji. You would have been filled essentially on Tuesday morning there. And your stop would have went at the highs, and you could see how well that has played out. The reverse works for longs, and this is a fractal system. It'll work on any time frame. This is a daily. You could throw it on a 5-minute chart if you want, 60-minute. Next, image number 9. Here's an example of this system, this setup on a weekly SPY. So you can see here back in 2022 in March, you had a short. The same setup there, the MACD kiss on the underside, the stochastic overbought, and you get your trigger off the doji. And you also had a long setup there in December when you had the doji and you had the stochastic oversold and the MACD kiss. So you'd have triggered off the doji high with the stop at the low there. Very objective setups there. And actually at the moment you have the MACD is kissing here and the stochastic is working oversold. But again, you need a trigger, and that's not really a ideal candle to trigger off of. So, but it is potentially set up there if the market were to have more of a doji this week, and then it would be set up for next week. But finally, image number 10. Here's a 5-minute chart of ES futures. By the way, futures are rolling over this week to the July contract. So the March contract will be expiring here soon. Anyway, so this shows you this same setup on a 5-minute. So if you look here, this is Friday. You could see around 11:40, you had the MACD kiss. You had a stochastic overbought a little bit, almost close enough to overbought. You had a nice objective short off that doji. And then later on at just around 1:30, you had a long setup right there. You could see the MACD kiss. MACD had crossed, it had kissed, pulled back a little bit, didn't cross, and you had the stochastic nearly oversold, and you had a doji there to trigger off of. So again, very objective system that you could use on any time frame and any stock, any index. And that's just one example of a system. And that's what Breakpoint Trades is good about, is system development and also teaching you guys, giving you tools and tricks like this to use on your own. Okay, enough about that. Let's go ahead and move back to the general market newsletter. So, image number 11 here. This chart, this is a yearly candlestick chart. So you can see so far what things look like as of Friday. So the Dow this year down 3.7%. The S&P just up about 0.5%. NASDAQ still holding up strong. NASDAQ up 8.4%, so it's been outperforming here. Russell up 1%. DBC Commodities down 4% for the year. And TLT up 6.5%. So that's a snapshot of what things look like at the moment. Next. Chart 12, here's a weekly chart of the major indexes with Bollinger Bands. So we've been showing on the Dow this coil, which broke down 3 weeks ago, back tested it. You see that? Perfect textbook example of breaking support, back testing the trend line. Beautiful short, and that's playing out. Closing a little below its weekly Bollinger Bands. The S&P had a wedge-like pattern. It broke to the downside here. Closed below this downtrend line, which we were looking to be potentially support. And here's what the NASDAQ look like. It still looks a little bit better. They haven't lost their broken downtrend line yet. And the IWM small caps leaking oil here, breaking this channel. Next. Chart 13, here's a monthly view of the major indexes going back to the 2009 lows. Remember, 2008 was the last time we had financial crisis, and this bank failure, gives people echoes, worries of back then. But anyway, so the S&P here, one thing I've been talking about, last month it found resistance at its middle Bollinger Bands. That tends to be in bear markets. You tend to lose the middle Bollinger Band and back test it as resistance. Again, you can see we had that classic blow off move in the previous bull market, which began in 2009 to 2020 to late 2021. You had a classic blow off move. You could just see the difference of slope here from just if I draw this in, you can see just the difference of slope of that last 2 years from the previous 10 years of that bull market. So classic blow off there, and I believe it's going to take a lot of time to work that off. Last year did a good job, but I think we probably need a lot more just given the backdrop of everything. Wouldn't be surprised if this bear market ended up lasting 2 years or longer, similar to how the tech bubble bear market lasted 2.5 years. So again, we'll adjust to whatever unfolds, obviously. Next, chart number 14. Here's a daily chart of the major indexes of the Bollinger Bands. Again, Bollinger indexes are now down to their lower Bollinger Bands, with the Russell having closed below its lower Bollinger Bands 2 consecutive days now. So very short term, we're a bit oversold here. Next, chart number 15. Here's the Dow. As you know, the Dow was forming this very tight coil pattern that we were showing for about 3 months. And it broke to the downside there in mid-February. That was bearish, rallied up, and look at that perfect back kiss of that trend line. Honestly, guys, while you can take trades at trend line breaks, your real low risk trades are your back test of broken trend lines like you have here. That was your super low risk long. Just like back here when you finally broke this almost year-long downtrend line in October, you did get a trade there, but you had a really good opportunity on the trend line retest there in December. So again, guys, that's just a standard theme in technical analysis. Otherwise, the Dow you can see is below its the 200-day moving average here as well, nearing that 50% pullback from the October lows. Next, moving on to the S&P 500 charts, which is our proxy. So here's the monthly view of the S&P going back to the 2008 lows. Again, we had that bull market. We had that blow off from the 2020 to late 2022. We identified that as a end of that bull market way back in December 2021, January 2022. And you can see overall it's been playing out. The MACD was so extended above zero, and it actually has worked back near the zero area, so that's a positive. We haven't tested this channel line, which I do believe that is one of my targets longer term, if not down here in the 2000s. Another thing, this 14 stochastic on a monthly chart, it tends to find support at the 50% area in bull markets, but then it loses that in bear markets like it did here last year and, of course, 2008. Next, chart number 17. Here's another monthly chart of the S&P. Shows that indicator at the top. Again, very useful indicator. Just a standard 14 stochastic on a monthly. You can see how good that has been in bull and bear markets. Here's a channel. And the cyan line is the same as the middle monthly Bollinger Band. It's the 20-month moving average. Again, you can see this perfect parallel channel. I drew it connecting the body here instead of that low wick. So I believe over time we'll test that and maybe even one of these fibs down here. Usually bear markets, guys, will retrace at least 38% of previous bull markets. And 38% of the previous bull market is 3230. Okay, still a ways off, but stronger bear markets, 50% fib or lower, and you can see where those would lie. Next, chart number 18. Here's another S&P chart. This goes back to the 1970s lows. So you got a couple trend lines here. First off, we have our channel, which again we haven't even gotten back to the low of that channel. could see how wide the moving average ribbon was on that blow off move. So it's been being worked off. It's not cutting back a little bit. It was crazily expanded there back in late 2021. Not sustainable. Okay. And anyway, if over time we were to lose this channel, you can see you got another longer term channel line from the 1974-75 lows, which connect the 2008 lows. Next, chart 19. Here's another yearly candlestick chart. Again, just a very simple concept. Over time, price will eventually retest its mean, which is the 9-year EMA, and just it does that in bear markets. And you can see even with this recent action, you can see how far we are still above the 9-year EMA. I do believe we're going to eventually retest that and undercut it like we usually do in bear markets. Next. Chart 20, here's a zoomed out view of the yearly candlestick chart going back to the early 1920s. So you can see in all the previous bear markets, you always undercut the 9-year EMA. Okay, it's been a while since we've hit it. I mean, obviously we did hit it there in 2020, but it was just a brief little candle wick. But I'm talking about a close below it. It's been a while, so just eventually price working below there is just think about it reverting to the mean. Other thing, in the long term on a yearly chart, a 3-length stochastic tends to get oversold in major bear markets. Again, it's going to remain to be seen if we see that. That would take quite a long time selling, maybe a year or two more in the market for that to occur. It doesn't occur very easily. You can see it's only on this essentially 100-year chart, it's only occurred 5 times. 2008, 2002, 1974, 1941, and 1931-32. So it's rare to see that. Not really something to even consider now, but it is something that just to be aware of. Next. Chart 21, here's a weekly chart of the S&P. Again, we've been monitoring this broken downtrend line. We basically lost it last week. We're obviously still well above its 200-week moving average, where we did find support there in October and rallied off of it. But we closed strongly below that trend line. Again, the bulls need to immediately recover that. We'll see what happens this week, or we could just continue down. Another thing to monitor is this trend line on RSI. So if you can see, we're still holding that for now. Keep an eye on that. Drawing trend lines on the 14 RSI I found very useful and objective signals. A couple other things here on the weekly. You could see the weekly 60-link stochastic. Again, so far we got a nice pullback from it testing the underside of 50% there in February. In August, that was that high, and then of course you could see how that is a very useful guide. Next. Chart 22, here's another weekly chart. Shows you the same trend line on the RSI, moving average ribbon. Now the ribbon's still bullishly stacked here, pinching. It needs to reverse if it's going to strongly, if it's going to keep that. But below here is just a simple cycle. And again, it's not perfect, but you could see how this little sine wave cycle has been marking these inflection points, such as here in October of 2021, here at this high in April 2022, a low there in October last year. And notice how this projects to around, again, mid-March or so for potential low. Well, we'll see if that ends up marking anything or not. There's also Lucas timing window around Wednesday of this week. Next. Chart 23, here's a zoomed in daily chart of the S&P. Again, you can see, we had that, we had a wedge into the 200-day moving average, and coming into March, we had a little bounce, but lower high. We formed a black candle doji. We had that perfect stochastic MACD set up there off that doji, and you can see lost the 200-day moving average on Thursday and retested on Friday and then sold off strongly. Okay, next. Chapter 24, here's a daily S&P chart. Again, as you know, we were monitoring this year plus downtrend line that was broken in January. We rallied up to this resistance here. We had that gap, open gap, resistance area. We stalled right there. And then the trend line on the RSI 14, as I said, very useful method of getting objective signals. You can see how all these trend line breaks have given me objective sell signals, catching these last major peaks. You had a sell signal there in early February, which played out. Now I can draw a downtrend line to here, monitor should price come back and break it, but that's obviously a long way from doing so. But you can see February ended up playing out with seasonality. February tends to be one of the weaker months of the year, and that obviously played out. We lost these various trend lines, 200-day moving average. Now, one thing to monitor here is symmetry. So we put that trade low in October when we had the fifth wave low MACD RSI divergence. Then we rallied up, pulled back, formed a higher low in December. That pullback was 337, let's just say 340 points. So this pullback, a symmetry target would have put it around the 38.58 area. We slightly exceeded that on Friday. So the pullback off the highs here, roughly 350 points. So 350 points versus 340. Is that a break in symmetry or is that too close for noise? Not sure yet. It's a little ambiguous. But if we were to get a follow-through sell-off, that would be a clear break in symmetry. I'm not going to get into wave counts tonight. The bearish view, guys, would have that last move up as a wave 2 perhaps, and we're in a wave 3. That's one way to view it. But again, let's see some of the gyrations this week before we worry about wave counts. Next. Chart 25, here's a half-day chart that we were showing late last week. We showed this potential head and shoulder, which broke late last week as well, Thursday and Friday. And again, if this were to achieve its objective price target, you could be looking at the S&P going way down into these areas again. But we did break that neckline, formed that lower high. We had a bearish moving average ribbon pinch that we warned about coming into the last week, and that obviously played out. Here's the symmetry. Again, we slightly exceeded that symmetry with about a 350 point move down from the highs. But, we didn't close below the symmetry. So that's something to watch coming into this week. Now, if we get a little rally bounce up, say on news of the little bailout of SIVB depositors, realize this broken trend line is now resistance. So you can maybe see a sharp rally back to there where it could potentially fail. So that's something to be aware of, guys. All right, let's move on. Chapter 26, there's a 2-hour view of the S&P. We broke below this lower channel line. This channel line is also resistance, guys. So like I said, if we get a sharp little rally in futures of the cash market tomorrow, watch to see if this acts as a resistance or not, or if we can get back above it. Okay. Next. Chart 27, here's a 60-minute view. Again, over a week ago, we got up into that resistance area we talked about. We didn't even get that close to that downtrend line, but this was a resistance supply zone we were talking about, and that's where price failed. You got your lower high bounce there. Notice your moving average ribbon pinching there. Beautiful area. And then it just sold off. No real there's only divergence here on this time frame is the little bit on the 5-length RSI right here. Nothing on the MACD or regular 14 stochastic RSI. Next. Chart 28, here's another 60-minute chart. So this chart ended up playing out. We favored this rally up to this 4078 being a wave X or wave C, needed another move down, and that's clearly what has transpired. Next. Chart 29, here's a 15-minute view Short term, again, we are quite oversold. We do have a little wedge look to this and a little MACD divergence, a little RSI divergence. So again, we'll see what news does early this week, Monday, coming into this, if we get a bounce. The largest rally in the downtrend from the 40.78 high was 56 points. So that's your symmetry to monitor if we get a rally out of here. Next, chart 30, here's a 10-minute view. Shows you the same wedge look to it here. Next, chart 31, triple Q's weekly view down 3.7% for the week. You can see the Q's stalled around a 38% fib just over a month ago. Again, this area is holding up relatively better than the S&P. Next, chart 32, here's a daily view. Again, closed essentially just a little bit below its 200-day moving average. It's still holding up relatively better than the S&P. You can see the trend lines on the RSIs gave excellent sell signals here in February. If we do get a rally, watch the downtrend line now on the 14 RSI. It needs to break that. You can see we're right around the 50 and 200-day moving averages. Next, chart 33, here's a 2-hour view. Again, notice price stalled early last week right at the down trend line. Couldn't get above it. We had that drawn in place before that as a marker. Next, chart 34, here's a 15-minute chart. Here on the Qs, you have almost kind of a little better looking wedge in my opinion. MACD divergence, RSI divergence. But again, it's going to just depend on what the news is this evening, etc. But again, as with anything, we're luckily looking for a big gap on Monday. So, if the market likes the news coming out this evening, we'll likely see a big old gap out of this pattern. So, too bad for the cash buyers. You have to play the futures. Next, chart 35. Here's a triple Q's Rinko chart. I've been showing this for a while. Again, you can see little support there and at the downtrend line. Next, chart 36, here's the KISS trend system, long only system for the triple Qs. As you know, this has been flat. On here, on the Qs, it's still above its 50% area on the 60 stochastic. So technically, it's still holding a trend there, but this KISS system's out. Next, chart 37, here's the 4 time frames. Very similar look to the S&P. I'm not going to spend time on that. Next, chart 38. Here's IWM small caps. Again, big sell-off from that recent double top. Your longer-term support's way down there, which was support last year, resistance in early 2020. Next, chart 39. Here's the daily view. Again, the Russell just puked last week. You can see it even lost that little channel. Lost that uptrend line from the October lows. Big volume there. It could be a little capitulatory volume, but, ugly. All right, guys, that does it for the general market. Let's move on, look at a few custom indicators. Chart 40, here's the NYAD advanced decline issues with the S&P. This gave an excellent sell signal warning back there in early February when the NYAD made a lower high while the S&P made a higher high. Look how great that sell signal worked. And you can see you had the same thing occur there end of November, caught that December sell-off, and in August. So great little indicator to use. Look for divergences between the two. No divergence here at the moment, obviously. Next, chart 41. This also gave a great sell signal. This is the BPSPX S&P Bullish Percent Index. I use 2 moving averages here, the 9 EMA, the 20 SMA. You can see you cross below those there in early February as well. Not perfect, but overall a good guide. Next, chart 42, here's the NASI indicator, NASI summation with the 2 and 5 exponential moving averages, sort of like a little mechanical system. This also gave a nice sell signal there in February and little lower high bounce after the cross and then has worked lower. Lines are nowhere near crossing to the upside. Next, chart 43, here's the VIX and the VVIX. VVIX is the volatility index of the VIX. VVIX was declining. VIX, the volatility in the VIX was going to unprecedented levels, and of course you could see how much the VVIX rallied back last week. Both the VIX and the VVIX closed outside their upper Bollinger Bands. The question is, do they close back inside or do they start running? The only way they would start running outside the upper Bollinger Bands would be if the market doesn't like what the regulators say and we just get an all-out crash. Okay, but a close back inside the bands could be a general buy signal. You can see how the VIX bounced off that supply or demand zone that we pointed out well in advance. Next, some things are getting sold here in the short term. Here's the put call ratio. So this closed outside its upper bands last Friday. Again, it's not at these real high levels like we've seen in the past, especially that one in December. I'm probably not going to see anything like that for a long time, but it is outside its bands, and a lot of times when it's outside its upper bands, you get at least a short-term bounce in the market. So that suggests something soon. Next, chart 45. Here's the NAMO and the NIMO McClellan oscillators with their Bollinger Bands. So they also both closed outside their Bollinger Bands for one day. Again, sometimes these indicators, will close 2 and 3 days below, but when they start closing below the bands, you're at least close to some sort of short-term bounce. Next, chart 45. Here's the NYAD advanced decline plotted as a cumulative. And one thing I pointed out here is it's been below its lower Bollinger Bands 2 consecutive days here. That's actually a positive. If you look in the past, back here in September, it was 2 consecutive days. And then shortly after you had a bounce, it formed a lower high only. Then you had another example here in the late September timeframe. And again, you did get a lower high bounce. All right. So this is below its bands 2 days. Here it was 3 days. So again, we're probably getting close. Next, chart 47. Here's the NASDAQ with the 52-week highs and lows. Again, 52-week lows outside their Bollinger Bands 3 consecutive days. The lows below the lower Bollinger Bands. Next, chart 48. Here's the percentage of stocks in the S&P 500 that are trading above their 20-day EMA. You can see this has now worked its way down to 5.8%. So it is getting quite oversold. What you like to see for real major bottoms is some sort of divergence between the indicator and price. You can see these positive divergences that formed at some of these major lows back here. We don't have any divergence at the moment, but it is quite oversold. Next, chart 49. Here's the percentage of stocks in the S&P above their 50-day moving average. So this has come down as well. It's not deeply oversold like it was last year a couple times, but it has worked its way lower. It was way up there for a bit earlier this year. All right, moving on to bonds. Chart 50, TLT 20-year bonds. We were looking for this to find support in this demand zone, and that's exactly what's happened the last couple weeks. Nice rally out of there. Next, chart 51. Here's TLT daily. Again, it basically pulled back to that symmetry area. It's had a nice rally since then. Next, chart 52. Here's the 10-year Treasury yield. Again, nice rally off that support area, but also nice sell-off last week. Remember, I've been saying that I thought this would probably pull back again instead of just going back to new highs at this point. Next, chart 53. Here's a daily. We talked about this island top early last week, and that has clearly played out. Now, you can see your support levels below, marked via that gap. Next, chart 54. Here's one of the yield curve charts. This isn't the official yield curve. It's the 10-year divided by the 3-month. But, one thing to note here is, this has occurred in previous bear markets. And, look how strongly negative this yield curve is. Recession is coming, guys. S&P 500 earnings are coming down in the future. So I do believe that's all going to take a long time to work its way out of the market. Next, Chart 55, here's high yield corporate. Tested its 200-day moving average on Friday. This is holding up a little better, so it's a slight short-term positive if it can hold this area. Next, Chart 56, here's the 60-minute view. All right, guys, let's move on and look at some market sectors. Chart 57, XLF financials. Again, as you know, this area got absolutely pummeled last week with that SIVB. But also, you can see before the news hit, you essentially had a little head and shoulder look to it. You can see the left shoulder, head, right shoulder. So it was all in place here before the news. You'll find that a lot with the markets. But you can look at that dump last week on big volume. Next, chart 58, here's the bank index itself. This obviously got pummeled more with that SIV bank failure. Quite oversold here in the short term. Again, we'll see what the news is coming out this evening from the regulators. Next, chart 59, here's a bigger picture chart, weekly view. Look at that candle. This is the biggest down candle on here, down 15.75% last week. This is the kind of one of our longer term targets we set last year. Man, wouldn't take much to get down to that area, would it? Next, chart 60, here's SIVB itself. Again, as you know, it got halted. Hopefully none of you were in this thing. By the way, some of us were, you guys were commenting on our trading community about Jim Cramer, who had recommended this, a month or two ago. So Cramer, he's kind of he's well known for that, picking this kind of crap. Hopefully you're not following Cramer. Next, chart 51, here's Bank of America now. Obviously sell off. Now it did come back quite a bit off of Friday's lows. Next, chart 62, here's JP Morgan. Again, this actually closed up on Friday. So initially sold off, and then, some customers realized that, hey, this is a safer area. So put some money into there. Next, chart 63, XOK Technology. Again, this is still holding up better than the indexes. Closing below this trend line break, but it's above its 50-day next support and 200-day moving average. Next, chart 64, here's semiconductors. Stalled at this downtrend line last week, closing right near this lower support, 50-day moving average. Still in the pattern. Next, chart 65, here's the inverse semiconductor ETF SOXS. If this were to break down, this is a way to play it. We had a previous trade idea here back in December that played out. Next, chart 65, transports. Again, breaking some supports last week. You still have the 200-day moving average below. Next, chart 67, materials. Losing a couple trend lines last week as well. Almost has a little complex head and shoulder look to it here. You can see the left shoulders, head, right shoulder. You still have the 200-day moving average below. Price is still above that for now. Next, chart 68, retail. Leaking oil here. Here's another trend line below to monitor. Next, chart 69, utilities. Still holding this trend line, but boy, it's vulnerable here. Next, chart 70, healthcare. This lost the trend line last week, back tested as resistance. Next, chart 71, biotech. Finally lost that trend line. We were showing this last week. We said it looked weak, and it finally lost it. Big dump the last few days. Next, chart 72, real estate. Broke that trend line on Friday or Thursday. Big follow through on Friday. Again, not surprised with the real estate housing market, guys, given with what's going on with the bonds and interest rates there. Next, chart 73, here's home builders. Leaking oil. Again, not surprising given what's been going on with rates. Next, chart 74, XLE Energy, leaking oil here, but you have the 200-day moving average below here to monitor. It's been mostly going sideways since November. Next, chart 75, here's the bigger picture view. This is a logarithmic chart. You got a couple trend lines here to monitor. at the moment. Next, Trevor 76, oil services, did bounce off that support in February, formed a lower high. Now it lost that trend line support there. Finally, Trevor 77, here's FEZ. This is the Euro Stocks 50. And by the way, this is one of the ETFs I'm working on for reversion to mean systems. But Steve pointed this out, kind of has a rounded top look to it here. Still holding the support, but this is a potential short if it breaks this. Okay. Let's move on to commodities. Trevor 78, DBC, still in this weekly coil pattern. To me, in my opinion, it's still in a long-term uptrend. It's just been consolidating the last 8 months. Next. Trevor 79, here's the daily. Again, you can see this big old ascending triangle pattern. So far, we haven't lost support. And this could go either way. Next. Trevor 80, here's the CRB to the S&P ratio. As you know, commodities have underperformed the S&P since 2011, but that changed in 2021 and especially last year. And since mid last year, commodities have pulled back and went sideways. But to me, guys, look at this ratio. You have the moving average ribbon pinching. You have a coil here forming. This really, again, to me, this looks bullish. It looks like it wants to go up. So if that happens, we're going to see commodities go much higher over time and likely the stock market go much lower. Next. Trevor 81, here's DBA, that's agriculture to the S&P, and you can see the same thing. Ribbons kind of pinching, you got a coil forming in the ratio here. Next. Trevor 82, crude oil. Crude oil has been going sideways here for about 4 months in this big old coil pattern. So just watch the way this breaks. You can also see the same trend lines on the RSI, 14. Next. Trevor 83, natural gas down 19.25% last week. Again, we had a rally for a couple weeks up near the 9-week EMA, stalled. The question is it going to make another low here or not? Moving average ribbon is quite wide. Next. Trevor 84, here's the daily. Again, it's been pulling back from that high there. One thing to watch here, actually, guys, look, your stochastic and is getting oversold and your MACD hasn't crossed. So you could get a potential MACD kiss stochastic overbought setup. Something to monitor this week. Next. Trevor 85, copper still hanging in there. Got big support here on this 395. We'll see if it can hold or not. Notice I drew a couple trend lines on the ribbon and the RSI. Next. Trevor 86, US dollar weekly view. So far, last couple weeks, it's pulled down a little bit, stalling near that 38% fib and moving average ribbon squeeze. Next. Trevor 87, here's the daily chart. Again, pulling back here. Last couple days. That's helped gold a little bit, but obviously not the gold stocks. Next. Trevor 88, gold on the weekly. Gold rallied up for the week, but guys, the thing that concerns me here at the moment is the ratio. This is the GDX-GLD ratio. It's turning down, and always it does better when the stocks are leading and they're lagging. So unless this reverses, we could see gold reverse back down. This to me is a fear trade, and if they come out and calm the markets a little bit, we may see gold sell off. Next. Trevor 88, here's a daily view of gold. Again, it rallied up last couple days, but to me, so far, a fear trade more than anything. I do believe we're going to get a lower high on this rally. Next. Trevor 90, here's another chart of gold with the GDX-GLD ratio. Again, the ratio is trending down. Unless this breaks up, unless the stocks can start outperforming, I don't trust this rally in gold. Next. Trevor 91, here's gold, silver. Silver has been underperforming here. Trying to find a little support near the 61.8 fib, something to watch. Next. Trevor 92, here's another chart of gold. This has the silver gold ratio, and silver tends to lead. So you can see you can draw a well-defined downtrend line here. Notice silver started out underperforming early before gold topped out there in February. Next. Chart 93, GDX, weekly view, down 5% for the week. Again, you can see the logical rejection off that 61.8 fib in the previous couple months ago. That was a perfect area to sell. Next, chart 94, GDX on the daily. Again, if you're long GDX, I talked about these higher low stops. You would have been stopped out back in early February. Some things to monitor going forward. Again, we've bounced near the 61.8 fib in February, stalled at the 20-day moving average, which we expected, and essentially formed a little double bottom there and Thursday, bounced on Friday off the lows. Again, guys, got to keep an eye on this. Again, we do have some divergence here on the MACD RSI, but you need to see the stock start outperforming here. So keep an eye on the ratio. Next, chart 95. Here's a chart of the ratio itself, GDX GLD ratio, and you can see how this is going to be great buy signals, sell signals. You get a nice buy signal back there in November when the ratio broke its trend line. You get a nice sell signal there in February, early February, and you can now define a nice, well-defined downtrend line to monitor. So if you want to be safe, wait for a confirmed trigger. You could wait for this trend line on the ratio to be broken. Next, chart 96, NVIDIA. We showed this as a short idea late last week. Wedge patterns playing out. Again, I didn't add any other trade ideas here this evening. We have enough to cover and look at this week. We'll likely post some ideas this week, but given the volatility in the market, no reason to force the issue on things. All right, guys, have a good rest of your Sunday, and let's see what comes out with the SIVB situation. Take care.